Hello, my friend. Welcome to Charlie Retail Invest. Let's follow the latest trend in US economy and share our latest analysis of stock and bond markets. Today is Friday, October 4th. There are lots of breaking news all happening this week that makes it very hard to catch up. Of course, the most important news is the aggravation of the conflicts in the Middle East. On October 1st, Iran suddenly conducted missile attack to Israel as a response to Israel's recent assassination of Hezbollah officials in Lebanon and strikes of Houthi targets in Yemen. Things are getting worse as this spiral of attacks and counterattacks goes out of control. And Israel warplanes carried out airstrikes at midnight on Thursday, October 3rd, on an underground bunker where more Hezbollah leaders were meeting. Moreover, it's likely that Israel will strike Iran's nuclear facilities in the coming days, which essentially ignites a regional war between Israel, Iran, and other countries in the Middle East that's involved. Aside from the huge geopolitical impacts from the conflicts, what affects the global and US economy is that the oil price has gone up dramatically since October 1st. If we look at the crude oil futures, we can see that it has gone up by over 9% in 3 days. More analysts now believe that oil price can shoot up to over $100 per barrel following the war in the Middle East, as Iran is one of the main oil producers in that region. And the warfare itself absolutely disrupt the production, transportation, and supply chain of the global oil industry, which ultimately leads to more expensive oil price. If we look at the crude oil index for the past 6 months, we can see that oil price has gone down by 20% from July till early October. And now the trend has been completely reversed due to the incoming war. We think the crude oil index has a good chance to go to near the 1-year peak of 86, which was reached in mid-April of this year, and may even break into the 90s in the next 2 to 3 months. As oil price goes up, the stocks and ETFs of the energy and petroleum sector have also increased dramatically in this week. Here is the price chart of energy ETF XLE, and we can see its price has gone up by 7.4% in the past 5 days, now reaching $92.3 per share. If we look at XLE price history for the past year, we can see its peak was reached at $98 on April 5th, and it can easily increase by another 6 to 8% from its current level to break above $98 per share and set a new 1-year high in Q4 of 2024. Another energy stock that we invested heavily is Occidental Petroleum, Oxy, and we detailed our positions on this individual stock in our video on September 17. Right now, Oxy's stock price just bounced from its 2-year bottom of $49 per share to $54.8 per share in 1 week. We think Oxy's stock price has a great momentum to go up much more, and is likely to go above $60 per share in the next 2 weeks as crude oil price keeps going up. And if we look at Oxy's price chart in history, we can see that Oxy's stock went to as high as $89 per share back in May 2008, 3 months before the stock market crashed in the 2008 global financial crisis. We think that similar to what happened back then, Oxy's stock price may continue to rise in Q4 2024 and Q1 of 2025, and will reach a new peak over $70 per share before the real stock market crash in mid-2025. So we plan to hold Oxy stock steady until its price is approaching $70 before selling them to make a profit. In general, a great selling point for energy stocks and ETFs would be around Q1 or Q2 of 2025, a couple of months before the economy hits recession, and they will bounce back after the stock market crashes to a bottom. and the Fed starts printing money to stimulate the economy. However, because energy stocks are much cheaper right now compared to tech stocks, their downturn during a potential market crash in 2025 would be much smaller than tech stocks as well. So it's pretty safe to have some exposure to energy and petroleum stocks or ETFs in late 2024. Apart from the war in Middle East, the US government reported on Tuesday, October 1st, that there were 1.13 job openings on average for every unemployed person in August, compared to 1.08 job openings in July. ADP National Employment Report also revealed on Wednesday, October 2nd, that private payrolls increased by 143,000 jobs in September, after rising by an upwardly revised 103,000 jobs in August. Among these increased job numbers, construction employment increased by 26,000 and the leisure and hospitality sector added 34,000 jobs. There were also solid job gains in education and health services, as well as professional and business services. However, on the flip side, the number of Americans filling new applications for unemployment benefits also increased last week, meaning that more people were getting laid off from their positions. Also, workers are finding it increasingly less rewarding to leave their current job for a new one, as new data from ADP showed that the median year-to-year pay increase for job switchers fell to 6.6% in September, down from 7.3% in August, and it's the lowest growth rate since April of 2021. So basically, companies now have more leverage against employees because it's much more difficult for them to find new jobs with decent pays. And it reflects the fact that our economy is not as hot as in 2021 or 2022. We can see clearly that the news come to prevent investors from panicking, such that the stock market can remain at an elevated level in terms of the stock prices. However, stock index hasn't changed much since mid-July of this year. If we look at the Nasdaq 100 Index ETF QQQ's price, we can see that it still hasn't bounced back to its all-time high back in July 10th, although the difference is quite small, just 3 to 4% away. As for SP 500 Index, it reached a new all-time high in September, but the level is still very similar to the previous peak back in July 16th. So essentially, the stock market is in a steady state where the index can't go up further much and won't drop much either. However, as we enter the final stage of the presidential election in November, we may see the stock market index drop by 5 to 10% from the current level, and that would be a pretty decent buying opportunity, and we can sell the stock index in December of this year to capitalize on the short-term gain. The Treasury bond price has been decreasing since Fed's first interest rate cut back in September 18. If we look at the 20-plus year Treasury bond ETF, TLT's price, we can see that it dropped from $101 to $96 in 3 weeks. This is because bonds were overbought in September, before the FOMC meeting. As a matter of fact, TLT's price increased by 14% from $88 in May to over $100 in mid-September. The market has already priced in Fed's interest rate cut to a terminal level of 3 to 4%. So the market sold on the news after rate cut was done by the Fed. Now the bonds became oversold and is very cheap to buy. Moreover, the dock worker strike over the East Coast, which happened on October 1st, would cause potential inflation to the US economy, as many shipments and goods cannot be unloaded from the deck due to the strike. That elevated inflation impact, along with the war in the Middle East, has downward pressure on bond price and can keep bond yield rising in the short term. However, the good news about the strike is that on October 3rd, the Dock Workers Union had temporarily reached an agreement with the U.S. Maritime Alliance, such that workers' wage would increase by 62% over the next 6 years, and the strike ended with immediate effect. That news is good for controlling inflation and adding support to bond price. We are still quite bullish on the performance of long-term Treasury bonds over the next 6 to 9 months, as the economy continues to cool down and the Fed continues to cut interest rates. We anticipate a good selling point of bonds in Q2 of 2025, when the stock market is in downward period, and bond price will continue to climb up. We've continued to buy long bonds, TMF and UBT for the past 2 weeks. Now, long bonds are over 80% of our investment portfolio, which we will update with you, my friend, in future. And that's the whole story of today's video. If you are a retail investor like myself and would like to know more about the US economy, updates, and our most recent trading activities, please give us a thumb up, share this video, and consider subscribing our channel, Charlie Retail Invest. We really appreciate your support. You are also more than welcome to leave your thoughts on the stock market and our economy in the comment section below. Thank you so much for your time, and I'll see you in the next video. Please take care.